Something unusual is unfolding in the world of precious metals, and most people still have not fully grasped what it means. Beneath the surface of daily market noise, a powerful shift is taking place. It is not the kind of shift that appears suddenly on a headline or flashes briefly across a financial screen. Instead, it is slow, structural, and deeply connected to the foundations of the global financial system. For those who hold gold or silver, understanding this shift may become one of the most important financial insights of the coming years. Across the globe, mining operations are pushing themselves to their limits. Production sites are running continuously, equipment is operating around the clock, and extraction levels are being pushed toward maximum capacity. This is happening despite rising energy prices, growing labor costs, and mounting operational pressures. Under normal conditions, such cost increases would force producers to slow down. Yet that is not what is happening today. Instead, the opposite is taking place. Before we continue, make sure to like the video, subscribe to the channel, and turn on notifications so you never miss important updates on gold and silver. Also drop a comment below and tell me if you currently hold gold, silver, or both. Now let's get back to the topic. The reason is simple. The economic incentive has become too powerful to ignore. When the value of what you produce increases dramatically, the calculation changes. Suddenly, the higher costs that once looked threatening begin to look manageable. The margins expand, the urgency rises, and production accelerates. What we are witnessing now is a period where the market value of precious metals has surged far beyond the expectations of many industry participants. The price increases have transformed the economics of mining itself. Operations that were once considered marginal have become profitable again. Facilities that were running at moderate capacity are now pushing their systems as hard as possible. In some cases, even older deposits that were previously left untouched are being reconsidered. But this surge in activity is not simply about opportunity. It is also about pressure. The demand for physical metals is intensifying in ways that few anticipated. Large-scale industrial buyers have begun securing substantial quantities of metal, often moving quickly and aggressively to guarantee supply. This behavior signals something important: fear of shortage. When large industrial sectors begin to worry about access to raw materials, they do not wait. They move quickly to secure what they need before the market tightens further. This sudden wave of demand has been quietly draining inventories that once appeared abundant. Warehouses that once held comfortable stockpiles are now seeing their reserves shrink. Registered and deliverable inventories have fallen to levels that are beginning to attract serious attention among those who follow the physical market closely. The numbers may still appear large at first glance, but the direction of the trend is what matters. Inventories are moving in one direction, downward. At the same time, industrial demand for silver continues to grow rapidly. Unlike gold, which is largely held as a store of value, silver plays a crucial role in modern technology. It is used in solar panels, advanced electronics, medical applications, defense systems, and countless other industrial processes. As global industries expand their reliance on these technologies, the demand for silver expands with them. Solar energy alone represents one of the fastest-growing sources of silver consumption. As nations invest heavily in renewable infrastructure, the need for high-efficiency conductive materials grows stronger. Silver's unmatched electrical conductivity makes it essential for these applications. That means every new solar installation contributes to the steady drawdown of global silver supplies. Meanwhile, the automotive sector is undergoing its own transformation. Modern vehicles, especially those relying on advanced electronics and electric power systems, require increasing amounts of conductive metals. The electrification of transportation is not just a trend, it is a structural shift that will reshape industrial demand patterns for decades. Defense industries also rely heavily on silver due to its unique physical properties. From communication systems to precision electronics, the metal plays a critical role in technologies that cannot easily substitute other materials. When geopolitical tensions rise, defense production often increases, which places additional pressure on the supply chain. These industrial forces create a powerful baseline demand that continues regardless of financial market sentiment. Even if investor interest fluctuates, factories still need raw materials to produce real-world technologies. This steady industrial demand acts like a constant gravitational pull on the physical supply, yet the story does not end there. Overlaying this industrial demand is the growing financial demand for precious metals as stores of value. Around the world, investors are increasingly questioning the stability of traditional financial assets. Government debt levels continue to expand, monetary policies remain aggressive, and inflationary pressures show little sign of disappearing entirely. When inflation persists, it erodes the purchasing power of currencies. Savings that once felt secure begin to lose real value over time. People start looking for alternatives. Assets that cannot be printed, diluted, or easily manipulated by policy decisions. Gold and silver have historically filled that role. For thousands of years, these metals have served as forms of wealth preservation. Unlike paper currency, they cannot be created out of thin air. Their supply grows slowly through mining, and the process of extracting them from the earth is expensive, complex, and time-consuming. This scarcity is what gives them their long-term value. When financial systems experience stress, the appeal of scarce, tangible assets tends to increase. Investors begin to view precious metals not simply as commodities, but as insurance against financial instability. In recent years, that perspective has gained renewed attention. Rising government deficits, expanding money supply, and mounting economic uncertainty have prompted many individuals and institutions to reconsider the role of hard assets in their portfolios. At the same time, real yields on government bonds are becoming increasingly fragile. When inflation rises faster than interest rates, the real return on these bonds can turn negative. In such environments, holding traditional fixed-income assets becomes less attractive. Investors begin searching for alternatives that can preserve value even when monetary conditions deteriorate. Gold and silver often become natural candidates during such periods. Meanwhile, the broader equity market faces its own challenges. Economic slowdowns place pressure on corporate earnings. Rising costs reduce profit margins. Consumer spending becomes unpredictable. During periods of recession or stagflation, stock markets can struggle to deliver consistent returns. This combination of factors, rising inflation, declining real yields, and uncertain equity performance, creates an environment where precious metals gain renewed attention. As this attention grows, the demand for physical ownership begins to increase. Coins, bars, and bullion products start moving out of dealer inventories more quickly. Retail investors join institutions in securing tangible assets that they can hold directly. But here is where things become particularly interesting. While demand continues rising, supply growth remains constrained by the realities of mining. Precious metals cannot be produced instantly. Discovering new deposits, securing permits, building infrastructure, and developing mines can take many years. Even once a mine is operational, increasing output is not always simple. Geological limitations, equipment constraints, environmental regulations, and labor availability all influence how much metal can be extracted. This means supply cannot easily respond to sudden surges in demand. Instead, the market must adjust through price. Higher prices incentivize more production, encourage recycling, and balance supply with demand. But that adjustment process can take time. During that transition, markets often experience volatility and rapid price movements. The current environment appears to be entering such a phase. Production is increasing. As miners push their operations harder than ever before, industrial demand continues expanding. Financial demand is rising as investors search for stability in uncertain times. Meanwhile, inventories are slowly declining. When multiple forces move in the same direction, markets can reach tipping points where small changes trigger large reactions. For those watching closely, the signals are becoming clearer. The global precious metals market is entering a period where physical supply, industrial demand, and monetary dynamics are colliding. And when those forces collide, the results can reshape entire markets. But the most important question remains, what happens next? Because understanding what may happen next could determine whether investors simply observe these developments or position themselves before the next major move begins. To understand where the precious metals market may be heading, it is necessary to step back and examine the broader economic landscape. The forces driving gold and silver today are not isolated events. They are deeply connected to the structure of the global financial system, government spending patterns, and the policies used to manage economic crises. Over the past several decades, governments around the world have accumulated enormous amounts of debt. Borrowing has become a standard tool for financing economic growth, supporting public programs, and responding to financial downturns. In many cases, borrowing has expanded far faster than economic output itself. When debt levels rise beyond certain thresholds, maintaining stability becomes increasingly difficult. Governments must allocate larger portions of their budgets towards servicing that debt. Interest payments grow, fiscal flexibility shrinks. In such environments, policymakers often face difficult choices. They can attempt to reduce spending, increase taxes, or rely on monetary expansion to manage the burden. Historically, many systems have leaned heavily toward the third option. Monetary expansion allows governments and central banking systems to inject liquidity into the economy. By increasing the money supply, they can support financial markets, stimulate borrowing, and ease pressure on debt servicing costs. However, expanding the money supply can also create inflationary pressures. When more currency circulates in the system without a corresponding increase in real goods and services, prices tend to rise. Inflation does not always appear immediately. It can move gradually through different sectors of the economy before becoming widely visible. But once inflation expectations take hold, reversing the trend becomes significantly more difficult. This is where precious metals begin to play a critical role. Gold and silver have historically served as monetary anchors during periods of currency instability. Their value is not determined by policy decisions, government budgets, or debt issuance. Instead, their value emerges from their scarcity, durability, and universal recognition. When trust in paper currency begins to weaken, tangible assets often attract increased attention. Today, multiple signals suggest that the global economy may be entering a period where inflation remains structurally elevated. Energy costs fluctuate, supply chains continue adjusting, and geopolitical tensions influence commodity markets. At the same time, government spending remains historically high. Large-scale infrastructure projects, defense expenditures, social programs, and crisis response initiatives require vast financial resources. Funding these commitments frequently involves issuing new debt. When debt issuance expands faster than the pool of willing investors, monetary authorities may intervene to stabilize markets. Such interventions can involve purchasing government bonds, injecting liquidity into financial institutions, or maintaining accommodative interest rate policies. While these actions can stabilize markets in the short term, they may also contribute to long-term inflationary trends. In an environment where inflation remains persistent while economic growth slows, a particularly challenging condition can emerge: stagflation. Stagflation combines stagnant economic growth with rising prices. Businesses struggle with declining profitability as costs rise, but consumer demand weakens. Employment markets become unstable. Financial assets that depend on strong economic expansion may face significant pressure. Historically, stagflation has proven especially difficult for traditional investment portfolios. Stocks can struggle as corporate earnings decline. Bonds may lose value if inflation erodes their real returns. During such periods, assets that retain intrinsic value often become more attractive. Gold and silver fall into that category. Unlike financial assets that rely on future cash flows or economic expansion, precious metals function primarily as stores of value. Their worth is not tied to corporate earnings, government budgets, or interest payments. Instead, their value is rooted in their physical properties and their limited supply. When financial uncertainty increases, investors often shift portions of their portfolios toward assets that provide stability during turbulent conditions. Precious metals have repeatedly demonstrated their ability to fulfill that role. Yet what makes the current situation particularly unique is the convergence of multiple demand drivers simultaneously. In previous cycles, gold demand often rose primarily due to financial concerns, while silver demand fluctuated more heavily with industrial activity. Today, both metals are experiencing pressure from multiple directions at once. Industrial demand for silver continues to expand due to technological advancement and energy transformation. Investment demand rises as individuals seek protection from monetary instability. Meanwhile, supply growth remains constrained by geological realities and lengthy development timelines. This convergence creates the potential for powerful market dynamics. Another factor adding complexity to the current environment is the structure of modern trading systems. Precious metals markets include both physical transactions and paper-based derivatives. Futures contracts, exchange-traded products, and various financial instruments allow traders to speculate on price movements without necessarily taking delivery of physical metal. While these systems provide liquidity and price discovery, they also create situations where paper claims on metal can significantly exceed available physical supply. As long as most participants settle contracts financially rather than demanding delivery, the system functions smoothly. However, if a larger percentage of participants begin requesting physical metal simultaneously, supply constraints can become more visible. Recent movements in inventory levels suggest that physical markets may already be tightening. When large industrial buyers move aggressively to secure metal, available inventories can shrink quickly. If investment demand accelerates at the same time, the pressure on supply may intensify. Mining companies are responding by pushing production as high as possible. Facilities operate continuously. Equipment runs without interruption. Workers maintain demanding schedules to extract as much material as possible. Even so, mining cannot expand infinitely. Ore grades decline over time as higher quality deposits are depleted. Extracting remaining material becomes more energy intensive and expensive. Environmental regulations and permitting processes add further complexity. These structural challenges limit how quickly supply can grow. In other words, even though production is running at maximum capacity, the industry cannot simply flood the market with new metal overnight. This creates an interesting paradox. On one hand, producers are working harder than ever to bring supply to market. On the other hand, demand pressures continue building from multiple directions. The result is a market environment where balance becomes increasingly fragile. Small shifts in sentiment, policy decisions, or geopolitical developments can trigger outsized reactions. For investors observing these dynamics, the key question becomes timing. Markets often move slowly until they reach a threshold where momentum accelerates rapidly. When that threshold arrives, prices can adjust far faster than many expect. Throughout financial history, precious metals have experienced periods where years of gradual buildup suddenly transform into powerful upward movements. These movements rarely occur in isolation. They tend to coincide with broader shifts in economic confidence, monetary policy, and global stability. The current environment contains many of the ingredients that have preceded such movements in the past. Expanding debt levels, persistent inflation, tightening physical supply, rising industrial demand, and growing financial uncertainty all contribute to a complex and potentially volatile landscape. For those paying attention, these signals form a picture that becomes clearer with each passing month. The world is entering a phase where hard assets may once again take center stage in global financial discussions. What happens next may depend on how quickly these underlying pressures intensify. Markets often appear calm until a moment arrives when confidence shifts and momentum accelerates. When that moment comes, prices can move faster than most people expect. Those who understand the forces shaping the precious metals market today may find themselves far better prepared for what unfolds tomorrow. For anyone holding gold or silver, the message is simple. Pay close attention, because the next move may not just be another market fluctuation, it could be part of a much larger financial transformation already underway.